Welcome to The Explainer. Today, we're jumping right into a pretty profound secret of modern finance. We are going to explore exactly how Wall Street manages to measure the unmeasurable uncertainty. When millions of dollars are changing hands in the options market every single second, the absolute most important number on a trader's screen usually isn't even the price of the asset. It's actually this hidden language of probabilities and risk. And by the time we wrap up here, you're going to understand exactly how to speak it. So, if I tell you an option costs exactly $5, is that a total bargain or are you getting ripped off? Well, the truth is, without context, raw price is just a complete illusion. $5 could be dirt cheap, or it could be incredibly expensive. We really can't know without understanding what kind of uncertainty we're actually paying for. Okay, let's dive into this. Picture two stocks, right? Both are trading at exactly $100. Stock A is sleepy. It barely moves a few cents a day. Stock B, on the other hand, is an absolute roller coaster. Think of your favorite heavily shorted meme stock, regularly jumping several percent in either direction. If you're buying an option, which one of those is more valuable? It's stock B, for sure, because options have asymmetric payoffs. Your downside is strictly capped to what you paid, but your upside is theoretically unlimited. The value of an option fundamentally depends on the probability of extreme future outcomes. So how exactly does the financial industry standardize all this chaos? That brings us to Section 1, the illusion of price. Now, originally, this is the textbook way the legendary Black-Scholes model was designed to work. In theory, it's a fairly straightforward formula. You plug in known factual inputs, the underlying stock price, the time left to expiration, and the current interest rates. Then you plug in your best estimate for volatility. The model turns the crank and spits out a correct theoretical option price. But as you'll see, modern financial markets have completely transformed how this model is actually used today, which triggers Section 2, the big reversal. Here's the real aha moment. Wall Street totally flipped the script. Instead of using volatility to guess the price, they take the actual observed market price that millions of traders are already agreeing on, plug that directly into the model, and work backward to solve for volatility. It's this brilliant reverse engineering process to extract the market's true expectation of uncertainty. And that reversed output, that's what we call implied volatility. Now, I want to be super clear about what this actually means. Implied volatility is not a crystal ball. It's definitely not a guarantee of what the stock will do. It is simply the exact volatility assumption that makes the model's theoretical price equal the actual market price. It's literally the market collectively putting a specific price tag on fear, excitement, and uncertainty. Think about it this way. Historical volatility is strictly factual. It's looking backward in the rearview mirror at past turbulence. But implied volatility, that's looking straight through the windshield, pricing the unknown future. Imagine a historically calm biotech stock the day before a massive FDA approval announcement. Historical volatility is practically zero, but implied volatility is going to skyrocket because the market is actively pricing in that unknown outcome. Now, here is a little secret that most finance textbooks tend to bury. The original Black-Scholes assumptions, they're actually flawed. The math assumes a perfect, frictionless world, constant volatility, continuous trading, zero transaction costs, perfectly rational behavior. But come on, financial markets aren't sterile laboratories. In reality, stocks pay surprise dividends, interest rates fluctuate wildly, markets gap overnight, liquidity suddenly evaporates, and, well, human beings panic. So if the model is so flawed, why on earth do institutions still use it? Well, that leads us right into Section 3. The language of uncertainty, because despite its flaws, it has become the ultimate translator. Let me show you exactly what I mean here. Imagine two identical tech stocks, both sitting at $100. If you look at their options and one is priced at 20% implied volatility and the other is priced way up at 60%, you instantly know everything you need to know about how the market views them. That 60% stock has a massive amount of uncertainty priced into it. The model translates those messy, unreadable dollar premiums into a clean, standardized percentage that anyone can instantly compare. And Black-Scholes also breaks down risk into these different measurable dimensions, what traders commonly call the Greeks. It's basically rapid-fire risk management. Delta is your price movement, telling you how much the option moves when the stock price changes. Gamma measures how fast that delta is accelerating. Theta is kind of your enemy. It shows the value burning away simply because time is passing. Vega tracks our new best friend, implied volatility, and Rho handles the impact of interest rates. It gives traders a beautifully standardized vocabulary for multidimensional risk. And this brilliantly illustrates what happens when you map all of this out in the real world. You get a volatility surface. Now, in a perfect, theoretical Black-Scholes world, this chart would be totally flat. But ever since the 1987 market crash, it's absolutely not. Notice how the out-of-the-money puts carry a much higher implied volatility. That's called a volatility skew. It exists because real-world investors are terrified of market crashes, so they eagerly overpay for downside insurance. Which brings us to the most powerful philosophical takeaway of this entire explainer, Section 4, a flawed but useful map. Think about it through this famous quote, "The map is not the territory." A map simplifies reality. It completely ignores every individual blade of grass and every single tree. But that exact simplification is what makes the map useful in the first place, so you don't get lost. Black-Scholes simplifies the enormous, chaotic complexity of global finance into a mathematically structured benchmark. Because ultimately, the model doesn't dictate true value. The market does. The model is just there to provide the baseline. In fact, the deviations, those specific places where the market completely disagrees with the model's simple math, that is exactly where the most valuable, actionable information lies. It tells you exactly where the market is pricing in fear, greed, and extreme risk. So I want to leave you with this thought to chew on. Absolutely anyone can pull up a stock ticker and see the current price. But the raw price of the asset is only half the story. The real secret of Wall Street is understanding the price of the unknown. Next time you look at a stock, don't just ask where it is today. Ask yourself, what hidden uncertainty is the market really pricing into tomorrow? Keep exploring, keep questioning, and we'll catch you in the next explainer.